Hello, everyone. And today we're going to start our chapter number 6, that is chargeable gain. And this is a very important chapter for this personal tax paper. And in the exam, expecting at least 15 marks from this chapter. So you need to be very much careful and practice as much as possible for this chapter. And there are a few things that we have to remember from this chapter, especially some formulas for the chargeable gains and some sort of calculation how we do that. So it's not very difficult chapter, but we need a little bit practice for this chapter because in the exam we're expecting 15 to 20 marks. So it's quite important for your exam. So let's have a look at the chapter overview, what you have here. So there's a lot of things here you can see. So the first thing we can see here, how to calculate the capital gain tax. Now, let me tell a little bit about the capital gain tax, what it is and why we have to calculate all of this. The capital gain tax is all about the disposal of the fixed asset. Now, let's try to understand. Let's say I have a business and I sell flour. For example, I have a business, I sell flowers to the people. And I have some furniture at my business, but selling the furniture is not my business. But selling this flower is my main business. Now, what happened? Like, let's say for any reason, if I like to sell this furniture to someone, and if I make a profit on that, this is called the gain on disposal. Now, when you have a sales, for example, if I sell flour to the people or to the customer, we call it sales. And when I sell the furniture from my business, we call it disposal, so that we can differentiate. Selling the flour is my business. This is my business main activity, and for that reason, we call it sales. But selling the furniture, or I have a computer, I have an old furnitures or sort of car or machinery. So this sort of thing, if I sell and if I make some gain, we called it disposal gain or gain on disposal. Now, it has happened when as a person, as individual, sometimes, for example, we have sort of asset, but this is not our business. Let's say, for example, we buy a painting 20 years before. We buy a land 20 years before. We buy a car 100 years before maybe your dad buy and give it to you. So this asset, when you buy, that time it was quite reasonable price or cheap, but now it is in market, let's say it is very expensive. So when you try to sell this thing and you compare the cost, you see there is some gain involved. For example, 50 years before or 20 years before, if you buy a house or land and you paid 50,000 pounds. But now if you sell it, you can sell it for 80,000 pounds. So 30,000 pounds, you are making a gain. So you have to pay some gain, or you have to pay some tax on this gain, and this is called capital gain. So when you sell a capital asset, and if you make some gain, we called it gain on capital asset, and you have to pay some tax. Now, the capital gain tax is a 10% and 20%. It is fixed. There is no like 45 or 40%. So you have only basic rate. If you are a basic rate taxpayer, then you have to pay 20% tax. If you are a higher rate taxpayer, you have to pay 20%. If you're basic rate, 10%. So 10% for the basic rate taxpayer and 20% for the higher rate taxpayer. And the due date, exactly like the self-employed, you have to pay to HMRC by 31st of January following the end of the tax year. So this is the basic thing we have to know to calculate the capital gain tax, and also like how to do all the calculation we have to know. So let's have a look at what we have here. So we can see here it's a disposal in the tax year. So disposal means sell. The reason we call it disposal because we sold the capital asset. So the reason it is a capital asset, and for that reason we call it disposal. Capital asset. And we have a chargeable person. Chargeable person, the individual who is selling that asset. Then chargeable disposal. Chargeable disposal, sell, gift, insurance proceed, and not on debt. Now, debt is relevant to the inheritance tax that we're going to see later on. But here, it is not only sell. If you give a gift to someone, it is possible the capital gain tax can be raised. For example, if you give one asset as a gift to your brother or to your friend, so it will be treated like a market value, how much is priced that time and how much you paid for that. So the difference will create the gain, and you have to pay tax on that. Then we have a chargeable asset. So we need to see which asset is chargeable. Now, all the asset is not chargeable. Some asset we have that is exempted. So you can have a look here is the exempt assets. So there are a few assets that will not create the capital gain tax. For example, the car, then guild, QC, base, and some chattels, premium bond, and individual savings account. So this sort of thing is exempted. So if in the exam, if you say this sort of thing, you really don't have to calculate any capital gain tax on that. Let's have a look at the calculation. How to do the calculation? So you have proceed. Proceed means the selling value. So sold, how much you sold it. So sold. And then usually it's a proceed minus disposal cost. So how much you sold it and how much is the disposal cost. Disposal cost means the incidental cost of selling. For example, if I like to sell this asset, there is some cost involved. For example, the marketing fee, for example, and legal cost, for example, an agency fee, for example, any commission. This sort of cost has to be deducted from the disposal. For example, if I sell an asset for £10,000, and there was some cost, let's say the commission is 1,000, so actually my net proceed will be 9,000, not 10,000, because actually I'm getting 9,000. Then connected parties, this is happen when you sell something to your close relatives. For example, you sell to your uncle or you sell to your brother. So it is like kind of your direct relatives. So if you sell a asset to your direct relatives, sometimes it is possible you are charging them less. So for example, market value is 50,000 and you are charging them 40,000 because they are your close relatives. So if they are your close relatives, we have to charge the market value always. We cannot charge like how much you charging to that customer, how much he's paying to you. So it's not, because maybe he's paying to you less because he's your close relatives. For that reason, we have to use the market value. A spouse and the civil partner is exempted. So between the husband and wife, any sort of transfer will be exempted. Remember that. So between the husband and wife, if we do any sort of transfer, that will be exempted. Then we have a gift. So if you have a gift, this is again the market value will be considered and the disposal cost. And cost is the cost plus acquisition cost and enhancement. Now the cost is means like the original cost. When you buy that asset, how much was the actual price? So this is the first thing you have to know. This is my original cost of the asset. And the next thing is like enhancement means improvement. For example, if you buy a house and that time there was only one balcony or one couch and you make extension. For example, if you buy land or if you buy like, for example, machinery, the capacity is improved because you do some improvement on that machine. So for any reason, if you make some improvement of this asset, then it will be the part of the cost, but it has to be improved the efficiency. For example, let's say we have a computer. Before it was 8 GB RAM, but now we put 16 GB RAM, and because of that, the computer become now faster and it work fast. If this has happened, then you can add this cost with this computer. Let's have a look. What else we have? Then we have something gain and losses. So if we make a gain, of course, we have to pay the tax. The tax is 10% for the basic rate, and for the higher rate is 20%. Due date always 31st of January 23. So for the tax year 21 and 22, the due date will be 31st of January 23. So when we are doing Financial Act 21 for this year, so of course our capital gain tax due will be 31st of January 23. This is the exact date when we do the self-assessment or tax return for individual. Now, if we have a gain, so you have to pay the tax. If we have a loss, it is possible we can offset the loss. For example, if we have a different type of asset and some asset create a gain and some asset create a loss. For example, you make a 3 disposal this year. Let's say you sell 2 land and you sell 1 painting. So the land create a gain and the painting create a loss. So it is possible you can offset this loss from the gain. So whatever is the gain you have, you can minus the losses from there. And if there any still loss remaining, you can carry it forward for the next year. So if you have still any loss left, So current year, use the current year. So if I have all the losses, I have to offset this year gain. How much is the gain this year? I have to offset from this year. If any losses is still remaining, then I can carry it forward for the future year. Then the brought forward use after the deducting. So this loss will be carried forward. That means it will be whatever closing losses for this year will be the opening losses for next year. Now, next year, when we're going to take out the loss, remember, before we take out the loss from the net proceed, we have to minus the AEA first. So balance forward use after deducting the AEA. AEA means annual exemption, and that is 12,300 is a fixed amount. It's like a personal allowance. It's like a personal allowance, like up to this amount, you don't have to pay any capital gain tax. Now, why we have to deduct this one first? The reason we're going to deduct this one first, because the annual exemption will be wasted. For example, if my net proceed is 15,000, and let's say if I have a carried forward loss 5,000. So what will happen if I minus this one? For example, let's say my net proceed is 15,000, and my carried forward loss is 5,000. So if I minus this one first, what will happen? My net proceed left only 10,000. So I can only minus my AEA, that is annual exemption. I can only minus up to 10,000. So that means you can see the difference, 2,300 will be wasted because I cannot carry it forward the AEA. So AEA, annual exemption, cannot be carried forward to the next year. And for that reason, it will be wasted. So it's very important. We have to minus the AEA first, then we have to minus our loss that come from the last year, because if anything left, I can still carry it forward for the next year. All right, the next thing we have here, we have this one we already discussed, direct relatives. You have to use the market value. Then we have a part disposal. Part disposal is happen when you don't sell the whole property. So for example, if we have a land for 3 acres and we only sell or only dispose 1 acre. So when we don't sell the asset as a whole, and if we only sell, like for example, part of that, then we have to use a formula. This is the formula A divide A over A plus B to the cost. So find out the cost, we have to use this formula. So you're going to see it how it work, but it is for the part disposal when you decide not to sell the whole property at the same time. Then we have a chattels. Chattels, we have 2 types of chattel. One is wasting chattel, one is non-wasting chattel. Wasting chattel is all about if it is 50 years, it is less than 50 years, it is exempted. And if it is more than 50 years, so if you can use this asset more than 50 years, then you have to calculate the capital gain tax. So less than 50 years life is exempted. Now we're going to see what type of chattels and how we're going to calculate. Chattels is quite tricky. There are a few rules you have to remember, but of course, like if you remember, that is not difficult. But there is some rules is called 6,000 rules, so we need to remember all of this. And in the exam, definitely at least 2 to 3 marks question will come from only from the chattels. All right, so let's move on. The next thing you can see here, there is some who is the chargeable person, individual or chargeable person, this and that. So you know this thing. So let's look at the template. How are we going to calculate the capital gain? Now remember that capital gain and the chargeable gain, this sort of word, you have to know the meaning of that. So when you see the word chargeable gain, doesn't mean it's a capital gain. So you need to know very specifically what does that mean. The capital gain, what does that mean? The net proceed, what does that mean? The chargeable gain and the taxable gain, especially in this three word: capital gain, then chargeable gain, and taxable gain. taxable gain. So you have to be very much clear about this three word, because the tax will be calculated based on the taxable gain, and we have to make sure what is the information we have to add it or deduct in order to get the taxable gain. So first, if we look at this template, we have to find the disposal consideration, or it could be market value. The market value will be only used if we sell to the direct relatives. Other than we're going to use the disposal consideration. Disposal consideration means the value, the sales value or the proceed value, how much we're selling it for. So this is the disposal consideration. Then less incidental cost. Incidental cost means how much is the cost relevant to the disposal. As I said, the agent fee or the commission or maybe legal cost. So to sell this asset, you have to pay this money. So you have to deduct, and that will tell us the net proceeds. So how much actually we're going to receive by selling this asset. And after that, we have to minus the less allowable cost. So including the acquisition cost. Acquisition cost, when you buy first time, how much you paid for that asset. Then less enhancement expenditure, so we have to minus that, and that will give us the capital gain. It could be give you a loss as well, so it could give you either capital gain or capital loss. All right, let's move to the next one. Let's have a look how to calculate the cost. This is actually the same thing that we discussed. Incidental cost could be state agent, legal fee. Allowable cost, the original purchase of the cost. Enhancement cost is any sort of improvement if you're done with that. Now, from the capital gain, so let's have a look. So disposal consideration. Let's look at this example. So we have Jack brought a holding cottage, 25,000. So that's my original cost. Jack brought a holiday cottage for 25,000. So that's my actual cost when I purchased that. He paid a legal cost 600 on the purchase. So this will be added with that because of course, like this is part of the cost. Then Jack spent 8,000 building extension to the cottage. So Jack made some extension. That means his improvement. This will be also part of the cost. Jack sold the cottage 60,000. He paid estate agent 1,200 and legal cost this. So this is basically relevant to the selling cost. To make it sellable, I have to spend this to cost. So 60,000 I sold it, but actually I'm not going to receive 60,000 because 1,200 will be taken by the agent and 750 by the legal person. So I said disposal consideration even 60,000. Then I have to minus this two because this two I'm not going to receive. This two will be gone from the 60,000. So the net proceed, or actually I'm going to receive 58,050 pounds. Then less allowable expense. So this is 25,000 is the original cost, and 600, this is the one we have paid legal fee when we buy the assets. So we have to minus that. And also we have enhancement cost, 8,000 we minus that, and that gives me chargeable gain. This is my chargeable gain. Remember this word is a chargeable gain, which is not a capital gain. It's not a taxable gain. So very, very careful with this thing. So this format gives us chargeable gain. Now let's do this one. The next one we have activity one. Let's try that. So I have here Mr. D brought an asset 127 February 1986. He incurred a legal fee. He sold the asset 38, and we have expense 1,500. While he owned the asset, improvement cost 3,000. It's quite straightforward the way we done. So let's find how much is the capital gain from here. So capital gain is the amount where we have to pay the tax, but there is some sort of deduction we have to do. For example, if we have any loss from the last year or annual exemption, we're going to see it one by one. So proceed 127. Let's have a look. So we proceeded for proceed is 38,000. So sold 38,500. This is the selling price. Less selling expense. The selling expense is 1,500. We can see this is minus. So net proceed will give me 37,000. Then less the cost. Now with the cost, we have 12,700. That's my original cost, the purchase cost, 12,700. Then you have a legal fee on purchase. Legal fee is 500. This is all minus. Less enhancement, we make some enhancement. This is 3,000. minus 3,000. And that will give me the capital gain, that is 20,800. That's my capital gain. It's quite straightforward, so it's no complicacy here. Let's move to the next one then. Then we have to find how to calculate the taxable gain. This is the important one because the tax will be calculated on that. So once we have the capital gain or chargeable gain, from there we have to see what else we need to do. So current year gain, this is my current year gain, that one we calculate on the last question. From here, we have to see is there any current year loss. So how much losses we have, current year losses, all the losses we have to minus this year, then that will give us net capital gain. From there, we have to minus the annual exemption, that is 12,300. And from this annual exemption, we have to minus any loss come from the last period. And you minus that, and that will give us the taxable gain. So this format, all the format, you have to make a template on the paper, you have to make a note, because this template has to be on your head. All right, annual exemption is 12,300, and remember, it cannot be carried forward. It has to be used this year, otherwise it will be wasted, because every year you have this amount, 12,300. All right, let's move to the next one. I have some example here. Let's try this one, activity 2. So 2021 and 2, TED making gain 45,000. So this one is a direct gain. It's not we are doing enhancement, improvement, this and that. So they give us a gain straightforward. So we start from the gain. So 45 and 10. So there is 2 gain. Also make a loss 48. TED has no loss brought forward. So there is no loss from the last period. So we have only current year loss. And the question here is the net capital gain 21, 22 before annual exemption. And TED has a loss carried forward. How much a loss he will carry forward? So let's have a look at that. So first we need to find it out how much is the total gain. So total gain of 45,000 we have here, plus we have 10,000, and that will give me total 55,000. This is my total gain. Now I have to minus the current year loss. Remember that current year loss, all the loss, current year loss, not from the previous period, but current year loss you have to minus first. So 48,000 we minus, and that gives me 7,000. That's my taxable gain, 7,000. So net capital gain, net capital gain, 7,000. Now, the next thing, before we calculate, now we have to see, the question said we don't have any loss from the previous year, so only we have to minus the annual exemption. But even if we have any loss from the last period, we have to make sure like we use the annual exemption first, then we use the loss from the last period, because the annual exemption cannot be carried forward. So minus the annual exemption from the net capital gain, annual exemption amount, that is 12,300. And if you minus that, and that will give us 0, we can see even though net gain only 7, but I can only offset up to 7,000 for the annual exemption, because it cannot be, remaining balance cannot be carried forward. So it said the net capital gain before the annual exemption is 7,000, is the one. And there is no loss to carry it forward because it's 0. So we don't have any loss that we're going to be carried forward, because all the gain will be offset by the annual exemption amount. All right, let's move to the next one. The next one, we're going to look at the prior year loss. So let's have a look if I have any loss from the previous period. So Tara makes a gain on a property 2021-22 of 12,800, proceed of 25,800. That's my sales, and that's my cost. The cost is 13,000. And the gain is 12,800. So this was my selling price, this is my cost, and the difference gives me the gain. She makes no other disposal, and Tara has a loss brought forward from the previous year, 10,000. So you have some previous year loss. Okay, net capital gain before the annual exemption and the loss carried forward. Okay, so let's have a look. The total gain, we have 12,800. So the gain, and from the gain, you have to minus the AEA, that is annual exemption amount, 12,300. And it gives me nil. 12,300. So gain is 12,008. So now it's not a nil, so it's 500, isn't it? The difference. So our gain is, net gain is 500. Net gain is 500. I'm not going to pay any tax yet because I have some loss from the last period. So 10,000 come from the last period. So it's a loss brought forward, loss BF. That is, we had 10,000. So we can say from 10,000, we're going to use 500 here. So we have only 500 gain. So we can only offset 500. And it will be nil here. So 500 will be offset here. And 9,500 will be carried forward again for the next period. Because I don't have enough gain to offset my all the losses from the previous period. So my previous period loss was 10. So I cannot offset all the 10 because I have a net gain only 500 after the annual exemption amount. So I can only offset 500 for this period, and 9,500 I'll move to the next period and next period until all the losses offset. So the current year losses I have to offset first, remember that. Then I have to look at the other losses. So Tara net capital gain before the annual exemption is 12,800. And the loss to carry it forward, 9,500. So this is the loss we have to carry it forward for the next period. This is still like we are learning, because this question will be mainly come for the calculation of the capital gain tax. So here they are saying how to calculate the capital gain tax up to, if you are a basic rate taxpayer, then 10%. If you're a high rate taxpayer, it is 20%. So you can read this thing, it will be maybe helpful. All right, I hope by this time we understand how to calculate the basic band and the higher band. So the difference between always will give us the amount, how much you're going to charge, 10 or 20. For example, 37,500, 700 is the maximum of the basic band. And anything is under that, it will be 10%. But for example, if it is more than 37, so up to 37,700 will be 10%. Anything up of that or more than that, it will be 20%. Okay, let's have a look on example, computing the capital gain tax payable. Mr. D, see activity 1, had a chargeable gain 20,000. They're saying from the activity 1. So the capital gain is 20,800. He has a taxable income 31,000. How much capital gain tax he need to pay? Okay, so he had a taxable income. So taxable income is 31,200 and chargeable gain is 20,800. That means the income is a total of more than like kind of 50. So 20 plus 30, 50, isn't it? So let's try to do it. How much tax we need to pay for this calculation? So chargeable gain. So we said capital gain, we have 20,800. This is my capital gain. And we have to minus the annual exemption because we don't have any current year loss. So we have AEA. So annual exemption 12,300. We minus that, and that will give us the taxable gain. That gives me 8,500. So from the capital gain, if we minus the annual exemption, the amount we have, we call the taxable gain. So the taxable gain, we have 8,500. Now this 8,500, we have to pay the tax. Now let's have a look how much we need to pay for the 10% and how much will be the 20%. So let's have a look. So the first thing we need to know, how much is the left for the basic band. Now we can see his taxable income is 31,200. So we know our basic band rate, or basic rate, whatever the basic band is, 37,700. It is fixed. It is fixed for every single person. So 37 up to 37,700, we don't pay tax more than 10% for our capital gain tax. But here he have gain of 20 and 31 for the income, so it is more than 37. So I need to know from 37, if I minus the 31,200 is the taxable income, so we minus the taxable income 31,200. If we minus that, how much basic band he left for the 10%? So that gives me 6,500. So that means from 8,500, the gain he have. So he have a gain, taxable gain. He need to pay the tax on 8,500. So on 8,500, first 6,500, he can pay 10% because the basic band is still remaining by 6,500, because this is the difference between the basic band and the taxable income he have. And another the one we have, the difference between these two, that is 2,000. This one he have to pay 20%, because anything more than 37,700 he need to pay 20% tax. So this one will give me 6,500 times 10%, 650, and 2,000 times 4%, 20% is gives me 400. Now see, if we added these two, that will give me 1050. This is my total uh, taxable, the capital gain tax you have to pay. So 10 and 50. So this thing is very important. Remember that if this is a taxable gain, if the question said not chargeable gain, but taxable gain, then the things will be completely changed. That time we don't have to minus this annual exemption, because annual exemption is already minus. When you see the word taxable gain, that means the annual exemption is already deducted. All right, so let's have a look. The next one, then we have the self-assessment date. The date is 31st of January. We already said that. Then we have a part disposal. Now, the part disposal question normally come in the exam sometimes, so you need to make sure you know the formula. The formula here is to find out the cost. This is A over A plus B. A means the value of the part disposal. So how much you sold it. So value of the part disposal. What is the part you sold? How much is the value for that? Then B means the market value of the remainder. So for example, if you have a 3-acre, let's say 1 acre you sold for 10,000. So A means 10,000, and the 2-acre remaining, this value, let's say 15,000 market value. So we said 15,000. So it will be 10 in the top and 10 plus 15, market value of the remainder. And after that, you have to multiply with the cost, the original cost, and using this formula. So first you need to find the gross proceed, how much we sold it for, and we minus the selling cost, that's the net proceed. And from there, we have to minus the original cost. And to minus the original cost, you have to use this formula, A over A plus B. So we can see here, A means, and what is means of A and A plus B, multiply with the original cost, that will give you the cost, and minus that, that will give it again. All right, let's have a look. Let's look at one example. Let's have a look if you understand it. Let's do one activity straight away. So we have activity 5, part disposal. So Tom brought 10 acre of land for 20,000. So 10 acre, 20,000 is the total. 10 acre is 20,000. He sold 3 acre of land, 10,000. So 3 acre he sold for 10,000, and the remaining 7 acre, he have the value is 36,000, and disposal cost is 950. The gain on the disposal of the land and the cost of the remaining land carried forward is. So we need to find it out, both of this. So let's try to find it out. Gain on disposal first. First, we need to know how much we sold it for 3 acres. So we said disposal is 10,000. So we sold it for 10,000. And we have to minus any relevant cost. This is incidental cost or disposal cost. We minus that 950, and that gives me the net proceed. Net proceed, and that is 9050. And after that, you have to see how much is the cost. Less the cost. And how we calculate the cost? This is A divide A plus B. A divide A plus B. So A, we have the value of the land we sold for 10,000. So A is the 10. A is the 10, and B means the remainder of the value of the asset. So 7 acre, how much is the value? 36. And you have to multiply with the total cost of the asset, that is 20,000. So 20,000. So 10 divide 40 times 20,000, and it will tell me how much is the cost for 3 acre, the part disposal. So that gives me 4348. 4348. If you minus that, that will give me 4702. So this is my gain on disposal. Gain on disposal 4702. And instead the cost of the remaining land, how much is the cost remaining? So total cost was 20,000. So from 20,000, if you minus this one, 4702, and that will for how much is the total cost? We said the cost is 4348, not 4702. So let's have a look. This is the cost. 4348. This is the cost we calculate by using this formula. So the remaining cost will be 15,652. So 15,652. This is the remaining land cost. So all you have to know how to use the formula: A divided A plus B times by the total cost, and it will give you the cost for the part disposal, and you have to minus it from the net proceed. That will give you the gain. And to find the total cost remaining for the remaining asset, so whatever for the 3 acre you minus from the total cost, it will give you how much is remaining for the 7 acre the cost. All right, so let's have a look what else we have. Then we can see we have some chattels. Now, chattels question is a very common in the exam, as I said before. So you need to make sure you remember this table. It's very important to remember this table. So this table is called 6,000 pound rules. So we have like cost. If the cost is less than 6,000, and if the proceed is less than 6,000, that means the sell. If the cost is less than 6, if the sales is less than 6, it is wholly exempted. No need to calculate any gain. So you don't have to calculate any gain. Then cost is less than 6, but proceed is more than 6. This one is a very common in the exam, very common. So what you need to do, any gain will be restricted to maximum of 5/3 times gross proceed minus 6,000. So this formula you have to remember, where the cost is less than 6,000, but the sales is more than 6,000. Calculate the gain compared to the maximum and take the lower figure. So we have to find two gain. One is from the formula, and obviously another one from the gain. So you have to find and take the lower one. We're going to see how it works. Then if the cost is more than 6 and the proceed is less than 6, it will be assume the cost is 6,000. So gross proceed deemed to be 6,000. So if the sales is less than 6, but the cost is more than 6, it will be assumed the sales or proceed is 6,000. So do normal calculation, but always use 6,000 as a gross proceed figure. So for example, if your cost is 6,000, 7,000, let's say cost is 7 and the proceed is 3,000, then you have to still use 6,000, not 3. Then more than 6 and more than 6. So if the cost is more than 6 and if the disposal is more than 6, it will be wholly taxable. That means you have to calculate the gain using the normal rules. Okay, let's have a look. Maybe if we do one question, it'll be more clear. All right, so let's have a look. This example is quite common in the exam. John purchased a painting for 3,000. On January 1st January this year, he sold the painting at auction. If the gross sale proceed are 4, so sales, if the gross sales proceed are 4, the gain on the sale will be exempted. Okay. If the gross sale proceed is 8,000, with the cost of sales 10%, the gain arising on the disposal, the painting will be calculated as follows. So here we are looking at if the gross sale is more than 8, because the cost is less than 6. So this is the formula we have checked before. So if the proceed is more than 6 and the cost is less than 6, so you can see here, if the cost is 3,000, that means less than 6, and the sales is 8,000, is more than 6, less than 6. So let's have a look. It's very, very important to remember this thing. There's a lot of thing here. So the proceed means disposal, and the cost means purchase cost. So if my purchase cost is 3,000, that means it's less than 6,000. And if the proceed is 8,000, that means it is more than 6,000. But if it is 4,000 purchase, that means less than 6, so it will be exempted. So we are not following that. So have a look here, gross proceed 8,000. So this is my sales 8,000. We have a 10%. This is the incidental cost. So 800 will be minus. So net proceed you have 7,200 less the cost. The cost you have 3,000. So we have a chargeable gain 4,200. The first one, because you have to find two, and you have to take the lower one. So proceed minus incidental cost, net proceed less the purchase cost, original cost, and it will give you the chargeable gain. And this chargeable gain, I'm not going to take it, because the formula said if it is more than 6, the proceed, less than cost 6, the cost, then you have to use the formula. And gain cannot exceed. So gain cannot exceed. What is the formula? 5/3. 5/3 times 8,000 minus 6,000. So 8,000 is the gross proceed, and 6,000 from the formula. 6,000 is from the formula. Always you have to minus with the 6,000. It has to be assumed is 6,000. So 8,000 minus 6,000, and we have 5/3, and that gives me 3,333. That's the second one. And between this, we have to take the lower one. So therefore chargeable gain will be 3,333. So if this is the situation, if the sales is more than 6 but the cost is less than 6, we have to use this formula, find two gain and take the lower one. All right, so let's have a look, and we have the same thing, that one we have just done. I can quickly do this one. It's a Orlando Gibbons purchased a rare manuscript for 500. He sold it several years later for 9,000. So the cost is 500, that is less than 6,000. And the selling price now 9,000 is more than 6,000. Before deducting the auction 1,000, then he also had antique broth, antique, that is a broth 7,000. So this is the cost. That means more than 6,000. And 2 years later, he sold for 3,000. That means less than 6,000. So cost more than 6, sold less than 6. Chargeable gain on disposal number A. So let's try the A first. So first we need to look at how much was the selling. 9,000. And with the 9,000, you have a commission 1,000. So 1,000 will be minus. So net proceed is 8. From 8, you're going to minus the purchase cost, is 500. And that gives me 7,500. Number one. First, and the second one, we have to use the formula. That is 5/3 and times by gross proceed, that is 9,000, minus 6,000 from the formula. So that will give us, if you use the formula, that will give you 5,000. And we have to use, this is the second one, we have to use the lower one between these two. Lower one is 5,000. So you're going to say 5,000 will be the gain for the first one. The next one, we have the loss on the disposal. So the second one, number B. So you can see here, we have a, the cost is more than 7, and the sale is less than 3. Even the sale is less than 3, we have to use 6,000, because you cannot come less than 6. So it said the proceed deemed or assumed 6,000, and the cost 7,000. So that brings me loss of 1,000. So this is my allowable loss. Allowable loss 1,000. Remember, the loss will not be the difference between 7 and 3, is the loss will be not be 4,000. Even though I sold it less than 3, but it will be always treated as 6,000. All right, so let's have a look. The next one. I have a transfer between the connected person. You have to remember that. Make sure you read this one. Direct relatives, so partner, spouse, grandparents, spouse, brother, sister, taxpayer. So this thing, like, you have to know who is the connected person. But remember, if there is a connected person, if a disposal by an individual made to a connected person, the disposal is deemed to take place at the market value of the asset. So if you sell any of the direct relatives, so what will happen, or connected person, so you will use the market value, because it is assumed maybe you will sell less price with your relatives. That's why you always take the market value. Transfer between spouse and civil partner is exempted. Between husband and wife and civil partner is always exempted. Spouse and civil partner are taxed as two separate people. Each individual has an exemption. Allowable losses individual cannot be set again. Okay, disposal between spouse and civil partner do not rise a chargeable gain and allowable loss. The disposal is said to be no gain, no loss. So if you sell to your wife or wife sell to the husband, it will not create any taxable gain or loss, because it treated as a no gain, no loss. It's like exempted. Transfer between the spouse. You can see one example. William sold an asset to his wife Kate. The current tax year 32,000. When the market value is 45,000, William acquired this asset 14,000 in 2005. Chargeable gain. As I said, between husband and wife, there is no tax, there is no gain, no loss. It will be treated like exempt. All right, let's have a look. This is the tax planning. So make sure you read the tax planning. It will be always give you some idea how can you save the tax. All right, this is the end of our chapter number 6. So this is our chargeable gain. Hopefully we have some idea now how to do the chargeable gain and this stuff, but make sure you revise some question from the exam kit, because the question bank will give you some proper question that is relevant to exams. So from here we take the idea, but actual practice you need to do from your question bank. So make sure you practice this chapter very well, because in the exam you will definitely see some question from the chargeable gain. The next chapter we're going to see, that will be our share disposal. So this is another important chapter you're going to see, because in the exam there is a question from the share disposal. So in the next lesson you're going to see our share disposal. Thank you very much everyone for watching.